All right, well, it looks like it's 12 o'clock Eastern straight up, so I think I'll go ahead and get started. I'm pleased to see the group here. Looks like we've got a pretty good group. I don't do very many presentations this late in the afternoon, or I guess in the trading day, so I'm glad to see everybody. This is going to be definitely an interesting day in the market, I'm sure, um, considering the fact that we've got everybody getting ready for the new administration, huge stimulus package. That's clearly going to affect not only the equity markets but the currency markets, the dollar, etc. So this will be an interesting year, if nothing else. Hopefully, a profitable one as well. The So I'm gonna start sharing my desktop right now. Hang on just a second, and I'm going to start by sharing a presentation here. It should say on the front cover, covered options. Is that coming up for everybody? This is actually a subject that I'm fairly passionate about. There are, and I want to preface my discussion today with a couple of things. Number one, covered options are it's not a simple concept. It's not complex either. It's something that anybody can manage. It's just, but there is a little bit of a learning curve. So considering that, and considering the fact that we have basically 25 minutes to cover this particular topic, I wanted to just give you a couple of things to think about. Um, the first is, as we go through this presentation, what I'm hoping to be able to do is to get a few thoughts germinating in your mind about, well, is this something that I would be interested in knowing more about, and uh, is it something that seems like it might have a place in my portfolio? Because if the answer to that question is yes, that it does seem like something that you'd like to learn more about, then it's easy and as an added benefit, it's free to find out a lot more. For example, on our site we have an entire course on Forex options that's completely free, so you can take advantage of that if you'd like. The second thing is, whenever I look at a strategy, I'm always asking myself two questions, or a trading tool or whatever it is. The first is, does it provide benefits? In other words, is the profitability that's possible with a X, Y, or Z strategy or whatever it is it worth the risk? So in other words, is there a good trade-off there? And I'll show you a couple of statistics as we go through this presentation that I think make that point pretty well. Covered options, specifically covered calls, is something that equity traders, stock traders, have been doing for a long time. There are hedge funds and ETFs and index options and all this kind of stuff based on that particular strategy because it's very effective at doing a couple of things. Well, it's also something that's been done by in one version or another by futures traders for years and years, and just now we're starting to see forex traders dip their toes into the water of the options world and see how options can help increase the benefits of profitability without necessarily increasing the risks out there. So it's a nice trade-off. The this, the third thing I would mention is, whenever I'm talking about a strategy or just trading in general, the one thing that for those of you who have heard me before or watch us on our site, learningmarkets.com or PFX Global or what have you, you know that we're always pushing, be very realistic about your trading. Don't listen to the hype and concentrate on the things that you can control, because there are very few things that a trader can actually control. We certainly can't control the market. We can't control unexpected announcements, et cetera, et cetera. So what are the things we can control? Well, we can control things like our stop losses, position size, money management, levels of diversification, asset class diversification. And covered options are actually one way to to put an entire layer of control over a trade that you would not have otherwise. And I'll show you what I mean. I've got two examples that I'd like to use today. Those of you who are familiar with covered options as a strategy, whether you've traded covered calls before or something like that, it'll look really familiar. There's two ways that I would recommend putting this strategy into play. For those of you who haven't, I hope to be able to at least lay the groundwork for a couple of concepts and then give you some resources that you can use to learn more. But it is something that can be used to increase your control, and I think that's where it derives its benefits. And then finally, there's always, whenever you talk to traders who have been trading covered options, either whether in the stock market or in the currency market or whatever it is, covered options is a great way to make some income in the market. So it's kind of a psychologically, I think it's nice for traders to see that a deposit being made when you're entering the trade, rather than just outlays of cash or tying up margin. So let's jump in. Let me talk about a few concepts here. We're going to be using calls and puts. These are they're oftentimes called, for retail forex traders to be familiar with these, as vanilla options, calls and puts. There are a lot of forex traders have dabbled in exotics like one touches and no touches, these kinds of things. For the most part, those are their gimmicks. But calls and puts are a lot more established. They've been around for decades and are especially if you're dealing with the exchange traded versions, have a lot of transparency, which is exactly what we need. And that's what I don't like about exotic options, is that they have no transparency. There isn't a competitive marketplace. They're being offered by the dealer in most cases, in almost all cases, in fact, currently. So calls and puts, that's what we're going to be dealing with. Now, calls typically are something that you buy when you're really bullish on a particular, if you're bullish on a currency pair, or if you're bullish on a stock or a futures contract or whatever it is, you would buy a call. Which means that if you are selling a call, if you're the call seller, you're actually bearish. And now the way that this plays into a covered options strategy is that it's kind of the takeaway. What you're doing when you're selling a call in a covered option strategy is you're long the underlying. So you're going to be long, let's say, for example, the euro dollar or whatever it is. You're long the euro dollar and you're selling a call against it, which is a bearish hedge in a very real way. That's exactly what it is. And it's put in play there to kind of curb the downside potential of that long position on the euro dollar without unduly capping your gains, without an offsetting benefit. So, and I'm going to go into a couple of case studies here in just a minute that will help explain what I mean by that, by both offsetting the downside potential as well as not unduly or disproportionately capping the gains possible from that long position. So we'll talk about that here in just a second. Put sellers, it's the same kind of concept, because and I find this is particularly relevant to spot forex traders who really think about things as just long or short. They don't equate short with equals bad. So like if you were talking to a stock trader and you were to say, attach an emotion to short trading, they would attach negative emotions to that. That's just pessimism, some kind of negativity about that. Well, forex traders, it's totally irrelevant. If you're short the euro dollar, that means you're actually feeling positive about the dollar versus the euro, or maybe just less negative about the dollar than the euro. So forex traders don't have really any emotional baggage tied up with being short, which means that they stretch beyond the covered call strategy and do covered puts as well. So a lot of forex options traders that I know and work with are just as easily trading covered puts as they are covered calls. Hence the reason why I titled this presentation Covered Options. So in the case of a put seller, normally when you buy a put, if you're a put buyer, that means you're bearish on that particular pair or that underlying asset. So you think it's going to drop in value because that put will increase in value as whatever it is that you're buying the put on falls. But if you're a put seller, it puts you on the opposite side of that transaction, which means that you benefit when when this particular option or when the particular underlying actually goes up. Now that means that it's kind of a bullish trade. Now, sticking with this whole concept around hedging and the benefits of covered options as a hedge or a way to offset some of my potential losses, you would apply a short put. So in other words, you'd be selling puts against a short position in the Forex. So for example, if you were really bearish on the euro dollar, and this is actually in a specific example I'm going to get to here in a minute when we look at the charts, if you were bearish on the euro dollar and you thought it was going to go down, you may want to control your risk by selling a put as well, because if the market in fact doesn't go down but stays flat or goes up, that put provides some protection against those losses. This is one of the reasons why we use a covered option in that situation, even though it seems a little bit contradictory to layer a bullish position on a bearish underlying investment. So if you're short the currency, that means you're bearish on that currency, but you're also selling a put, which is kind of a bullish, and it helps absorb some of that risk. So this is the nature of a hedge, is essentially taking the opposite position in an effort to control some of your risk and help smooth out your returns. In fact, if I go to the next slide here, one of the real advantages of trading covered options is that it smooths volatility. Now I've misspelled smooths there, but that's what the real benefit is. So here's an example on a random asset, and in this case I picked actually a currency index. Normal volatility unhedged was 13.89%. So, which is you'll see, depending on the currency or the underlying asset, your normal monthly volatility can be anywhere from 5%, 4%, 3% with bonds, 90-day bonds, for example, to 25%, 35%, depending on the really volatile asset. It really actually doesn't matter what this number is. Here's what actually matters is this next number here. Hedging with using a covered option in just a consistent way reduces that volatility by about a third. So regardless of what this number is, this number will come down to be about 2/3 of that number. So if you're trading a really volatile instrument, you're using covered options, you're probably going to peel off about a third of that volatility. And on top of that, in most studies that you can find on this that go over a significant period of time. So, for example, you can find some studies looking at covered option strategies going back about 18 years. So, a good example would be the BXM. If you're interested, it's a covered option strategy based on the equity market, but it goes back about 18 years, and you can get a lot of really good detail from that is transferable to other markets. It's not really that different because option pricing adjusts itself for volatility. So in a more volatile market, premiums are higher, so you're getting a little bit stronger hedge. But if you would like some more detail on that, so I'm getting a request for an example here, you could look at the studies that have been done on the BXM, which is a buy right index in the equity market. It's easy to manage. So for those of you who know who I am, I'm a big believer in longer term trading, not because it offers lower returns. In fact, I think quite the opposite. It offers lower costs because you're trading much less frequently, and you're hoping to be able to grab the much larger trends rather than the small little intraday or multi-day trends. So if you treat it that way, it's very easy to implement. It's really easy to manage. It's not really that big of a deal. Because it provides a little bit of a hedge, it also reduces the likelihood for whipsaws. So for example, we're going to look at a couple of examples right now where the hedge that the option provides is about the equivalence of offsetting 300 pips worth of losses. And I'll show you exactly what I mean by that here in just a minute. And so what that means is you can feel a lot more at ease when the market is kind of bouncing around. And I find it makes traders a little bit less likely to whip themselves in and out of positions really fast, and your returns aren't really impaired. So in some of the long-term studies that I mentioned just a minute ago, you'll find that the returns are there's a classic one actually done by the CME, the Chicago Mercantile Exchange, where it looked at the returns of option sellers versus who were even trading counter to the market trend versus those who were long a particular the underlying instead, and they outperformed in return. So now I wouldn't necessarily promise that. It's just I find that's an interesting statistic that I mean, you can pull the data yourself as easy as anybody else is, as easy as anybody else does, and find out for yourself. But that's what you'll find, is that it doesn't really cap the returns. It comes out about even. The real benefit you get is reduced volatility, which is, I think, important, especially important for smaller retail traders. So there are a couple of cons. And I want to be fair here. When you're selling covered options, you are capping your gains. What that means is that when you have a runaway trend, so for example, September through December last year through, the last quarter of last year. I mean, the trend was insane, right? And looking back on it, I think everybody thinks that they probably could have correctly identified it, and I'll bet some traders did, and captured a major portion of that particular trend. If you're selling covered options, you are kind of capping yourself when those breakaway trends happen. The counter to that, of course, is, well, but which does the market typically do? Those breakaway trends, or more random movement in a slower trend? I would argue the latter. And number two, it's complex. There is a learning curve. It's not overly complex, I don't think, but it does require a little bit of effort, a little bit of paper trading, a little bit of reading and studying to get a handle on what exactly these are, and how they work. But it's for as many people as I've talked to about this particular strategy, I have yet to find somebody who, with the proper amount of effort, couldn't figure it out and how to implement it into their own strategy. As a little side note here, I'm always I hate those advertisements that you see online all the time for trading systems that are quote unquote easy. It's almost like they should be advertising won't work. They, unfortunately, or perhaps fortunately, depending on your attitude, there really aren't easy ways to trade. There are interesting ways to trade, but there aren't necessarily easy ones. Everything's a little complicated if you really want to create some decent returns. Okay, so let's jump into. I want to go to. Show you a couple of things online. So I'm going to stop sharing my presentation for just a minute. And I'm going to go to my web browser. Now, so what you should be able to see right now is I'm on my site, which is learningmarkets.com. And Learning Markets is, by the way, it's a successor to PFX Global. For those of you who knew us at PFX Global, everything that was on PFX Global is now under the Forex tab here at Learning Markets. And here at Learning Markets, you can look up, we're going to be looking at chain sheets, at option chain sheets. So we've got, I can show you how to get those chain sheets here on the Learning Markets website. It's pretty easy to find, actually. And I'm going to look at this from two perspectives. First, I'm going to pull up FXA. That's the symbol FXA. And the reason why I'm pulling this up actually is that I've given this presentation before. And one of the questions that I get quite a bit is traders who are familiar with how covered calls work in, like, the equity market, for example, would like to know if there's an easier way to implement it than trying to manage two accounts, a spot account and then an options account, whether or not they could just do it all in one account. And well, yes, you can. And here's one way in which you can do that. So what I just brought up here is actually the Currencyshares. It's an ETF, which means that it holds the Australian dollar, so it's essentially the Aussie dollar cross. And you'll notice right now the last trade price, 65.85, is basically just two decimal place. They've just moved the decimal place over two spaces. So this is essentially the spot price if you were to put the decimal place in front of the 6 instead of in front of the 8. And the reason why they do that is that it really helps with pricing convenience, but it doesn't actually modify what you're really trading. It's essentially the same thing. So it's not as complicated as it looks. Now, in this case, and what I'm going to do is I'm going to run through and say, all right, let's say, for example, we were bullish on the Aussie dollar cross, and we want to be able to do a covered option play, but we want to be able to do it in our option trading account. So we don't want to have to mess with managing an underlying spot position as well as a option position in our option account. So we're going to combine this. We're going to do it all in our option account because this trades like it essentially trades like a stock, which you can trade in an option account. So we're going to buy the Currencyshares Australian Dollar Trust here for 65.85 a share. And up here across the top, there's a series of little tabs, and one of these is options. So we click on this tab here for options, and what it's going to do is it's going to bring up a chain sheet. Which so I'm having to make a little bit of an assumptive leap here that you understand what a call and a put is, at least in basics, and that you understand what a chain sheet is. If you don't, I have a resource for you that you can go check it out, and within a couple of hours worth of study, you'll have it down. So in this chain sheet, what we're going to be looking at is we're going to try to hedge ourselves. And I always suggest, just look for the at the money. Don't make it more complicated than it is. So 65.85, the strike price. So here's our strikes for all our calls. The strike price is closest to that particular underlying price, is 66. So you go over here and you look at your bid and your ask. You can it's pretty widespread, right? But you can typically assume these options are really increasing because the underlying is so liquid. You'll find the pricing is pretty aggressive. So you can typically cut the spread in half. So if you put your order in as a limit order and you cut it in half, so for example, if you were to put it in at $2, you're very likely to get filled. So or very close to that. So for example, if we were to put our order in and we were to try to get $2, that's essentially the equivalent. So we're long the Aussie dollar here. That's in essence that's what we've done by buying this Currencyshares ETF. So we're long the Aussie dollar. And at the same time, we're selling a call at a strike price of $66. So, or a strike price of 6,600, if you will, so 0.6600. And we're being paid $2 a share, or the equivalent of 200 pips to do that. So we've got that information. We've been paid 200 pips. We've bought the underlying. So we've got some protection here. We bought the underlying, by the way, because we want to make sure that we're covered. So if we're called out, we have the underlying available there to offset those losses. So let's go. I'm going to stop sharing my web browser here for just a minute. I'm going to bring up my charts. Okay, so you should be looking at my Metastock charts here, and I'm going to bring up the Aussie dollar spot. So the Aussie dollar, is it bottoming? Is it not? I don't know. But I think it's a valuable debate to have. And if, for example, you think that the Aussie dollar may be bottoming out, looking for a little bit of upside, then this is a really relevant discussion, because an option can help you. Selling that call option helps us to provide a little bit of hedge against some of that downside. So right now, for example, the Aussie dollar, I've got a spot price here of 65.71, so very close to my little delayed quote online. And so 65.73, and we sold a call that was a little bit out of the money, up right at 66, so just a little bit higher than what we are right now. But it gave us 200 pips worth of downside protection. So I'm going to put a little line here, 200 pips below where so that'd be 63.74 or so. Okay, so right there, we're basically down along we're kind of bisecting this consolidation that occurred from October through December. If by expiration, so these expire the third Friday of their expiration month, which in this case we were looking at next month's options, which is normal, February 09. If we're either up, flat, or at least don't cross this line, we're going to be able to essentially walk away with a nice profit here, because that money that we received when we sold the option is yours to keep no matter what, because it's the premium for that particular option. It's just a question of if the underlying, in this case the Aussie dollar, exceeds the amount that you were paid, then of course your losses could exceed the income that you received. But that those losses have been offset by at least that same amount, by 200 pips in this case, if we want to convert it to pips, or $200 if you want to look at it from the perspective of a mini contract, or whatever it is. And on the other side, however, if the market goes up, we still have upside potential as well, because we have not only that premium that we were paid, the $200 or 200 pips, if you will, But we also have the distance between where the market is right now, which is 65.73, and where our strike price is, which is 63. So another 28 pips or so. So we have upside potential of about 228 pips. So we could put another little line up here. So we're up about, so this is where we think the market's probably going to that looks like our profitability. Now, if the market exceeds that level, so if we're looking at it, if we think that the market is really going to take off to the upside, then we've capped our gains, but we've also offset our losses. So this is the trade-off. And what you'll find is that, and so an interesting way, if you're one of these data geeks like I am, and you want to do an interesting experiment where you think, wow, that makes sense, but does that seem like it's capping my losses? Do this, pull price history for whatever currency pair you're looking at, the Aussie dollar, for example, and look at the monthly range from open to close, how far it actually moved on a monthly basis. You'll find the norm is actually much tighter than we think about as traders, just because we get caught up looking at these kinds of moves right here back in October. So I always recommend you do your homework yourself to back up anything I'm saying, and that would be something that I would highly recommend, because this kind of stuff, like we saw from October through December and now through January, these fairly tight ranges, that's the norm. This is abnorm. So anyway, I'll give that a rest for a minute. Okay, so now what about the other side of this? Let's say, for example, you're not interested in trading this as like an ETF, for example, and you want, which is what we were just looking at when I looked at those Currencyshares. That's an ETF, so you trade it like a stock. So it really was like a covered call. We were buying shares of the Aussie ETF, which is just like buying the Aussie dollar on an unleveraged basis, and we were selling a call against it. Well, here on the Euro USD, we're doing something very similar, except that we're going to be buying the underlying spot, because it works pretty much the same way. It's just our management of that trade is just a little bit more complex, because we have two trades going on in two different accounts. We have our spot account, and then we are trading an option at the same time. There are index options available on the euro, for example, the euro dollar, that are exchange traded. They're offered by there's the Philadelphia Exchange, which is actually part of the NASDAQ OMX. And there's also options that are offered by the ISE, which I think in some cases are a little better on the ICE, depending on the option. And in some cases, the Philadelphia is a little bit better. But the concept is essentially the same. So in the euro, for example, let's say that we're bearish on the euro. We think that the euro dollar is going to continue to decline. The dollar is going to gain on the euro, whatever it is, and we're going to sell an option here. So I just got a question about open interest. I'm going to address that here in just a second. So we got the euro dollar here, and I'm going to short it. So I'm actually shorting a mini contract, a mini lot. So 10,000 units of the euro, and each pip down is worth $1 to me. If it does in fact drop. Now, if I want to apply a little bit of coverage, it works exactly the same way. I can sell an index option that covers the Euro USD, and it's going to give me right now. This one's more volatile than the Aussie, so it's offering a much higher premium of about 300 pips. So that puts us at about, if I were trying to cover this particular trade, I've got coverage all the way up to here, which means that if the market stays flat, channels, stays underneath this level, or drops, I wind up being profitable, where in a way it's kind of stepping in and playing a similar role to a stop loss, except that it's not actually accumulating. Once that barrier is hit, it's not actually accumulating an automatic loss or an exit in this trade. So this is what I mean when I say that it helps you to avoid some of those whipsaws. Conversely, if the market does go down, you still get to keep that premium, and we get to keep a little portion, the difference between the spot price and the strike price that we sold. So in this case, if we were to do this today, and we were looking at selling the 29.50, so the 129.50 strike price, which is just a couple of pips off, we'd be looking at a max gain of about 302 pips. We've offset any potential losses by 300 pips, and we live to fight another day. So the next month we can do the same thing over and over and over again. So, a couple of things before I answer this question. A couple of things I want to do to wrap up this conversation. If you have never traded options before, there was probably a lot of this discussion that may have been unfamiliar. So let me. I want to show you one of the resources you have available to you. Okay, I'm going to bring up my web browser here in a minute, but the so couple of things. If you haven't done this before, then and you need some resources, it's as easy to get as this. I'm going to put my URL in here. You can go to learningmarkets.com and click on the Forex tab. I'm having a trouble with my web browser right now, so I'm typing it instead. You can go to the Forex tab, and there's an entire course on Forex options that can help to explain exactly how do these things work, what happens at exercise, what happens at expiration, how do you enter one of these trades. And it'll even contrast the exchange traded options, which I talked about exclusively today, with there are over the counter versions available from some spot dealers. So there are those that are available, and we'll kind of contrast those and see what kind of benefits. The big benefit with those is, of course, they're very flexible. The big disadvantage is they're not very transparent. You're kind of at the mercy of the dealer. So there is kind of a drawbacks to this. So let me add. So that's how you can get some more information. The second thing I would do if I were anybody here trying to figure out how these things work, I would open a paper trading account to be able to trade in these options, just with nothing at risk, of course. At Cboe.com, they have two. This is the biggest options exchange in the U.S., and they have a couple of free tools. There's no obligation. You register with like your name and email address, and they have a couple of free tools there that you can use to paper trade options as well. So those are the two takeaways I would say, is that if anything seemed too complicated for you, check out the course and then paper trade them like crazy. See if you can figure it out. Just watch prices change. A lot of it will make sense as you kind of watch it evolve over time. So let me answer two questions. I got a question about why don't these options have a lot of open interest, or in some cases have no open interest. They're new. That's probably the best answer to that. It really depends on which contract you're looking at. So, for example, the euro typically has some pretty decent, open interest. Whereas you go look at like the Mexican peso, which is one that you can trade, is going to have almost no open interest. Now, that's not actually a big deal, because open interest is not what tells you how much liquidity there is in a particular option. It's the underlying. Now, in the stock market, typically there's big open interest when there's lots of liquidity in the stock. So they typically are the same. Because Forex options are pretty new, the open interest will be very low in the options, even though the liquidity is the best liquidity in the market. So there is no market more liquid than the Forex market. So it's really not an issue. You can still get fair pricing. I haven't had any problems being filled. I typically don't worry about it, because they have such a underlying liquidity in the Forex market itself that whenever you're worried about open interest, you're usually worried about being able to trade and get your orders filled, and there's typically not a problem with it, because the underlying is so liquid. So if you do not want to exercise your option, do you keep the premium? So if you're the seller, you're the one being exercised on, by the way. And so if you find yourself in a situation where you're going to be exercised on, you can either buy the option back, and yeah, you would keep any of the premium that's melted away. So between the time you sell it and the time you actually buy it back, some of that premium will have melted away. So that's your profitability. If you buy it right back just before expiration, for example, you can you're typically keeping the entire premium. Now, you may have some losses that are accumulated, which is why we cover it with the underlying position. But yes, you can enter and exit, and whatever portion of the premium has disappeared is really yours to keep. So Forex Champ asks, selling options is considered as naked. Should we not be wary of it? So I find it's ironic that a Forex trader is asking me about the risks of naked. Since Forex trading is like the ultimate naked, since you can be not only naked but hyper leveraged. Now I'm just giving you a hard time. Sure, selling options is considered a risky strategy. Covered options, however, are not naked because you have the underlying that you're holding. So, if you were just selling a put, then you have unlimited losses if the market were to just take off to the upside. But covering means that you actually own the underlying, so the profits in the underlying offset those unlimited losses, so you have fixed losses. You have fixed gains, so it's, well, you're not exposing yourself to unlimited losses in the option itself. So you fixed those losses in the option, and covered options are not technically naked. The Yeah, and so the second part of your question is I would say that's the only advantage that over the counter options, those options that are available from, there's a couple of Forex dealers out there who do offer calls and puts on Forex pairs, and they're very flexible. Their costs are very high. I haven't really, that's the only advantage that they offer, is that they're flexible, so you can adjust the size. So if you're trading exchange traded options, they're essentially the equivalent of a mini lot. So if you can't trade mini lots, if you're in the micro lot range, then, and you want to be able to trade options, you got to go to a Forex dealer who can help you break down those currency options to smaller increments. That is, I would say, that's the only advantage that you have in OTC. And if you're a small trader, that may make the difference. So, clearly that's something to consider. So Dark Knight is asking, does Cboe.com offer brokerage services? No, they don't. They're the exchange. So you need to get a broker who can give you access to the exchange. And any options broker, so literally, here's what you do. You go to Google and you type options broker, and you'll get a million of them up there. They're all pretty reasonable. The two paper trading software packages that I told you are available on Cboe that you can paper trade options with, including currency options. Those are both offered by, I think, the two best options brokers in the US, Thinkorswim and Options Express. So if you wanted to try those out, you'd get a real feel for what it was like to trade on their platforms. Let's see. So covered options have limited loss and profits. Then why not use regular stop loss in the FX market? So the big advantage here, Stoyan, is the options give you more flexibility. A stop loss, once it's hit, that's it. It's binary. In other words, the stop loss is either active or it's been executed. With covered options, you have a lot more flexibility. So they're covering your losses as you see how the market develops day after day. Because the market 5 days from now is not the market of today. And so it gives you a little bit more flexibility in your decision making. Not to mention the fact that because it pays you, essentially it pays you that risk coverage up front in the premium. So you have rather than a stop loss only accumulates a loss. So it's just one way to look at that risk control in a way that you're kind of getting your risk control payment up front, and then you have more flexibility, you have more control as the market continues to move. Specifically, it pulls volatility out of the market versus stop losses increase account volatility. That's just the facts. So and that's typically that's the real benefit. So how about using spread options rather than covered calls? Yeah, sure. Forex Champ, I agree. I find that spreading options is a good commission generator without really a lot of proven benefit to the option trader. I think that there are exceptions to that. So diagonals, for example, time spreads get a lot closer to. I think it's a real toss-up between, if you want to get more complicated, then you get into time spreads or diagonal spreads as a way to look at the same problem, this covered option problem, but in a way in which you're not maximizing your costs. So vertical spreads, for example, they're a real cost maximizer. I typically say, stay away from them. If you really want to trade them, trade them. But I think diagonals or some version of the covered strategy is going to be a lot better for the sole reason that it's just lower cost. It's all about costs. Can you reduce your costs? It's one of the few things you can control, and if you can, then that's a huge benefit. Well, thanks a lot for your time and attention. I really enjoyed it as usual. I love to be able to present to this crowd, and